Hi everybody. In the previous video, we calculated periodic depreciation expense and wrote an adjusting journal entry to record depreciation expense. In this video, we'll discuss accrued interest, calculate accrued interest expense for a period of time, and write an adjusting journal entry to record the accrued interest expense. Interest is the rent we pay for using somebody else's money. In this class, interest expense will be calculated for a period of time on the amount borrowed using a simple annual interest rate, not a compound. We're not going to compound interest in this class. That's way beyond the scope of this class. So we will be using a simple annual interest rate. The formula to calculate interest expense is PRT. I like to remember that because it kind of sounds like PERT, or it sounds like pretty, where P stands for principal, and principal is the amount borrowed. R stands for rate, and that's the simple annual interest rate. And T stands for time. Time is a fraction, the number of days in our calculation divided by 360 days in a year. Now I know you're already saying, what? 360 days in a year? That's wrong. There are 365 days in a year, usually. Well, just think of it this way. Bankers think that there are only 360 days in a year. So when you're calculating interest, no other calculation, don't apply 360-day year to depreciation or anything else, just to interest. When you're calculating interest, just get used to using a 360-day year. So the adjusting journal entry necessary to accrue interest expense is going to be a debit to interest expense and a credit to interest payable. By the way, you can use the same formula to accrue interest revenue on a loan that we make to someone else. And that journal entry would be debit interest receivable and credit interest revenue. But let's stick to interest expense for right now and work some problems. On January 10th, the business borrowed $20,000 from the bank with an annual interest rate of 10%. The principal and interest on this loan are both due next year. What is the journal entry necessary to record this loan on January 10th? Note this is a routine journal entry, not an AJE. Please pause your video and write the journal entry, then start your video again to check your work. The journal entry necessary to record the $20,000 note on January 10th is debit cash $20,000, credit notes payable $20,000. As of January 31st, the business had used the bank's funds for 21 days. You can count this on your fingers if you want, but don't count the first day. Better yet, use your calculator. Enter the number of days in the month that we borrowed the money. January has 31 days. And subtract from that the day on which we borrowed the money, the 10th. So 31 minus 10 equals 21 days. Apply the formula and calculate interest expense for the month of January. Please pause the video, do that calculation, then start the video again to check your work. Did you calculate $116.67? Principal of $20,000 times 10% annual interest rate times 21 days out of 360 days, or 21 over 360, equals $116.67. We make adjusting journal entries monthly, and we are now at January 31st. What is the adjusting journal entry necessary at this point? Go ahead and write the adjusting journal entry to accrue $116.67 of interest expense. When you're finished, start the video again to check your work. The adjusting journal entry necessary at January 31st to accrue January's interest on the $20,000 note payable is debit interest expense $116.67, credit interest payable $116.67. Well, that's all for this video. In the next video, we'll work a series of problems in connection with accruals and write a number of adjusting journal entries for good practice. See you next time.